In a congressional hearing room, a lawmaker is illuminating one of the darkest corners of the tax system. Are crypto miners creating products like farmers, or is the IRS punishing them with different rules? Representative Kerry's question isn't just about blockchain technology. It's a case study in how government suppresses new innovation and how America falls behind in global competition. And the IRS Commissioner's response? Wait and see what happens next. Context? The crisis of inequality in crypto taxation. Representative Kerry's opening is built on a simple comparison. When a farmer grows crops, when a miner extracts minerals, when a manufacturer produces goods, none of these are taxed at the moment of creation. But when a crypto staker validates blockchain transactions and creates new tokens through their own computational work, the Biden-era IRS treats them differently. They're taxed immediately at the moment of creation, unlike any other form of self-created property in American tax law. This isn't just a technical tax question. It's a window into how regulatory agencies can use their interpretive power to pick winners and losers, to favor traditional industries while strangling emerging ones. And Kerry is demanding answers. Why this double standard? Who decided that digital innovation deserves different treatment than physical production? Concept breakdown. Staking as production. To understand why this matters, we need to demystify what staking actually means. In proof-of-stake blockchain networks, individuals lock up their cryptocurrency tokens to help validate transactions on the network. Think of it as volunteering your computer's processing power to maintain the integrity of a decentralized ledger. In return for this service, the network rewards you with newly created tokens. Kerry's analogy is precise and devastating. This is functionally identical to a farmer planting seeds, staking capital, tending crops, validating transactions, and harvesting the yield, receiving new tokens. In traditional agriculture,
You brought up some points that I want to continue on a little bit. Not exactly in the same way that you did, but as you can imagine. But you phrased it in a way that I think is very important. And you said adversaries receiving the wrong message. I'm on my own time now. I'm not. Adversaries receiving the wrong message, and allies being told defend yourself and do so on your own. Those are important statements, I think, for people to understand. And so I want to bring up something that I don't think has been really brought up yet, and that is the emergency foreign military sales notifications that have come through. And before I ask you a question on that, I want to say, I get to have these meetings day in, day out, week in, week out, with the leaders of every country. And what every country, very literally, without pinpointing them precisely and who I spoke with, every one of them at the highest level is realizing is absolutely how much of an imminent threat Iran was to them. Where they were told in the last week, the last month, the last year, the last 10 years, by Iran very specifically, no, we would never target you. No, we would never target your civilian infrastructure. No, we would never target your oil and gas facilities. No, we would never, under any circumstances, target your ships. No, we would never do any of these things. Told over and over again, some of them in the last week, some of them in the last month, the last year, and so on. And all of them realizing that they have been long-term, pre-calculated targets of Iranian aggression. And that is what every one of them across the board is realizing. And so as we go to those the emergency authority which you've used to notify Congress about these sales, what are those sales accomplishing for our allies? What is it that they're doing for them? Why do they need that weaponry? What is it doing?
Thanks for the question, Mr. Chairman. Number one, I think it's important to point out, excuse me, during my confirmation process, I was clear and recognized the role of Congress in respect to the role, whether it be tier review and notifications. So we are not reestablishing a norm, number one. Number two, it's clearly an emergency. I don't think there could be a clearer emergency to prioritize capabilities to our partners and allies that are under the exact pressure and threats and attacks that we're seeing today in Iran. And I think to the last point of your question, there's a combination of things. One, what capabilities become available immediately? Number two, how can we expedite contracting and begin the important process, sometimes a long process. And number three, there are long lead time capabilities that we need to start the process down the road.
Do you know who in this room has to sign off on foreign military sales?
Go ahead, sir.
Myself and the ranking member. We have to sign off on all foreign military sales. For the last year, my ranking member has been withholding these sales to UAE and Israel. Billions and billions of dollars of sales. So one side of the mouth saying, oh, we need to do all these things to support our allies. And at the exact same time, literally being one of the four corners holding up all of these sales to Israel and UAE and other countries. That is why these emergency notifications took place, because these were being held up very directly by the person that sits directly to my left. That is an example of sending the wrong message to our adversaries and sending the wrong message to our allies as well. In the midst of conflict, in the midst of protecting Americans in the region or allies in the region, and it's unconscionable to me that that is what's taking place and what has taken place. And that's why I suspect there will be in the future continued emergency notifications. I wouldn't be surprised if there's another emergency notification that takes place in the future, because my colleague has been unwilling to support our great allies in the region, Israel and others. And that is a very serious issue. So I thank you for your time today. I think we're going to go to
Culture. The farmer isn't taxed when the wheat grows. They're taxed when they sell the wheat at market. That's called realization, the moment when theoretical value becomes actual income. But the 2023 IRS guidance broke this principle. It declared that newly created crypto tokens are taxable income at the moment of creation, not at the moment of sale. Imagine telling a farmer they owe taxes on their unharvested wheat, calculated at today's market price, even though they haven't sold a single bushel and might never be able to sell at that price. That's the situation crypto stakers face. Why this concept matters. The foundation of fair taxation. The realization principle is one of the bedrock concepts in American tax law. It exists for a simple reason. You can't pay taxes with theoretical value. You can only pay taxes with actual cash income. If you tax someone on unrealized gains, gains that exist only on paper, you force them to sell other assets just to pay the tax bill. This creates a cascade of economic distortions. Here's why Kerry's question strikes at the heart of regulatory fairness. The IRS has essentially created a special punitive tax regime for one specific type of productive activity. Not because the law requires it, Congress never passed a statute saying tax crypto differently, but because an administrative agency decided to interpret existing law in a novel, industry-specific way. This is regulatory overreach disguised as tax guidance. And it reveals a deeper truth. When agencies don't like a new technology or industry, they can use their interpretive power to strangle it in the crib, without Congress ever voting on the policy. Systemic impact, driving innovation offshore. Kerry pivots to the broader economic consequence. Many of the digital asset foundations that steward blockchain protocols are based outside of the United States due to regulatory uncertainty. This is the smoking gun. American entrepreneurs and developers facing a hostile regulatory environment are moving their projects to jurisdictions with clearer, fairer rules. This isn't just about lost tax revenue, though that's significant. It's about losing the next generation of financial infrastructure to foreign competitors. Blockchain technology, decentralized finance, and digital assets represent potentially trillions of dollars in future economic value. When American policy punishes domestic innovation while other countries welcome it, we don't eliminate the technology, we just eliminate our participation in it. Think about this in historical terms. In the early days of the internet, the US could have strangled e-commerce with punitive regulations. Instead, we created a relatively open environment, and American companies, Amazon, Google, Facebook, became global leaders. Now we're making the opposite choice with crypto, and the result is predictable. Singapore, Switzerland, and the UAE are becoming the new centers of blockchain innovation. The AI parallel, when tools outpace understanding. Kerry's second question shifts to artificial intelligence in IRS operations. And here we see a fascinating contradiction. The IRS is enthusiastically adopting AI to improve tax collection, using machine learning to process returns faster, answer taxpayer questions, and identify compliance issues. The Commissioner boasts about reducing amended return processing from 16 weeks to single-digit days using AI tools. But notice the irony. The same agency that can't figure out how to fairly tax crypto innovation is racing to deploy cutting-edge AI to maximize revenue collection. This tells us something important about institutional priorities. When technology serves the government's collection power, it's embraced. When technology empowers individuals outside traditional financial systems, it's taxed punitively. The Commissioner's description of AI in call centers reveals the agency's mindset, our ability to put information in front of our service representatives so they can get to it faster, allowing our representatives to answer more calls in a day. This is efficiency in service of the state. It's not inherently bad. Faster, more accurate tax processing benefits everyone, but it highlights the asymmetry. Individual crypto innovators get novel, harsh tax treatment that forces them offshore. The IRS gets billions in funding for AI systems that increase compliance pressure. One side gets the carrot, the other gets the stick. Closing, the test of responsive governance. This hearing moment is ultimately a test of whether American government can adapt to technological change or whether it will be paralyzed by institutional inertia. Can the IRS acknowledge a mistake and correct it? Can Congress exercise oversight that produces actual results, not just more meetings? The stakes are higher than crypto taxation. This is about whether America will lead or follow in the next generation of financial technology. Every month of delay, every vague promise of future review, every "we're studying it" response is a month where developers, capital, and innovation flow to friendlier jurisdictions. Democracy depends on institutions that can learn, adapt, and self-correct. The crypto tax question is a clear test case. The policy is wrong. The consequences are obvious. The solution is straightforward. All that's missing is the will to act. Final thought. As the Commissioner talks enthusiastically about AI transforming IRS operations while offering no timeline for fixing broken crypto tax guidance, we see the paradox of modern governance: rapid innovation when it serves state power, glacial inertia when it serves individual freedom. That imbalance is what every voter should be watching.